Good afternoon, everybody. Fáilte, welcome to the University of the Highlands and Islands. My name is Clive Mulholland. I'm the new Principal and Vice Chancellor of the University, and it is in that capacity today that I wish to welcome our guests, both at the front and in the audience. So you're very welcome. Universities contribute significant economic benefits to their regions. And the Whitty report that was produced earlier in the year clearly demonstrates the impact that they have economically on those regions. But that's not all they deliver. They also impact on the cultural, the health, and the social well-being of their communities. I believe that the University of the Highlands and Islands is in a fantastic position to contribute to both those agendas and to have a huge impact, not just regionally, but also nationally and internationally. And we will do this by working with other key organisations, such as the Institute of Directors. As host of this event, I would like to welcome you on behalf of the university, and I'd like to welcome today's speakers, who are both in a strategic position to talk about the economy and what they believe the future may or may not hold for the country in that regard. And if they can get that right, I will be truly amazed. Let me introduce our speakers. James Sproule has been the Chief Economist and Director of Policy at the Institute of Directors since January 2014. Prior to joining the Institute of Directors, James led Accusensor's UK research and global capital markets research, where he focused on thought leadership. He started his financial career as a merchant bank economist, working with both Bankers Trust, Deutsche Bank, and Dessner Kleinwort, and eventually helped to found the boutique bank Augusta and Company. Graeme Leach was Chief Economist and Director of Policy at the Institute of Directors until this year, when he left to join the Legatum Institute. Prior to the Institute of Directors, he was Economics Director at the Henley Centre, a Senior Economic Consultant at PAIDA, if I pronounced that correctly, Economic Advisor to Scottish Provident Investment Group, and prior to that, he was Chief UK Economist at the Henley Centre for Forecasting. James and Graeme will discuss their thoughts on the economy, and then we'll open the floor for questions. So I hope you see that today we have a very, very powerful set of individuals in front of us, and I look forward to hearing what they have to say. So now will you please join me in welcoming, who's going to go first? James, welcome.
Great. I'll come and leave my notes up here, and then I can sort of refer to them from time to time. Thank you very much. This is actually my first time in Inverness. It's not my first time in the Highlands Islands. Before my career in merchant banking, I was actually in the Royal Navy, and I spent some time in the Orkneys. I served actually on HMS Orkney, and then the Shetlands as well, and we even put a bit of some lead into Cape Wrath Peninsula at one point on your live firing ranges up there. So I have been up here before, but not to Inverness, so I'm really, really pleased to be up here. I'm also really, really pleased because if we look at the UK economy over the last few years, I think, well, if we're being charitable, we could all, I think, probably agree, let's not try that again. That was a little bit too hard and too long and too just frankly tough. And so I think it's worthwhile looking what really led to the problems that we've had, and where are we in recovering from those problems, because it's only in understanding that we're going to understand whether the recovery that we're now experiencing, which I think started in London but spread out to the rest of the country as well, is going to be sustainable or not. And a lot of people blame a lot of things for the downturn. I think the most pernicious rumor is that it's caused by the greed of bankers. As a former banker, I would just remind you that greed is a human emotion that's been around since pre-biblical times, so probably needs something else to explain it as to why this time it led to an amazing global downturn, whereas before this long-term human emotion hasn't led to that before. So I think it's probably something a bit more complicated than that. And the thing that was missed in the UK, missed in Europe, missed in the US was the fact that we let the money supply go. Now that's a pretty technical thing, but you might have heard in the US they call it the Greenspan put. Basically, every time the economy hiccuped from the early 1990s onward in the aftermath of the dot-com crash, the Federal Reserve just lowered interest rates a little bit. And everybody thought, oh, wow. And everybody thought it was brilliant. And you could see how brilliant they thought it. People started to say, there is no more boom and bust. Well, that sort of hubris has clearly died a death, and we've had a real big problem. So who borrowed too much? Well, households borrowed too much. British households are extremely addicted to debt, and I'll come on to that in just a moment as to how we're repairing that. Banks, they lent too much. Clearly there was a lot of, frankly, nonsensical lending that took place. Corporations borrowed too much because, well, when you're practically giving the money away, some of them took it. And governments borrowed too much. The idea that we were running a massive deficit during the time of the economic boom was something that Keynes himself wouldn't have thought was particularly sensible. So let's go through those four things very quickly to discern where we are in all of that. And we'll go in slightly reverse order. So governments. The government came in, this present coalition government came in and said that they would like to try and reverse what was the largest deficit in the G7 in one parliament, and that proved, in fact, too difficult. It's now going to be reversed, I hope, in two parliaments, assuming the coalition or some sort of a government that's committed to that gets back in. Now, Labour Party has also said, by the way, that they are committed to doing this, so I think there is a reasonable chance that we will see continued fiscal consolidation. And the reason that you have continued fiscal consolidation is because, and some people have said to me, why can't we just run more debt? Why can't we do that? Let me put that another way so that you can perhaps see why I don't think that is sustainable. What we are saying when we would like to run a long-term debt is that we would like poor Chinese people to continue to give us their spare savings so that we can continue to live beyond our means off into the indefinite future. Do you think that's a sustainable plan? Sustainability is a really good thing, but it isn't just about energy and things like that. It's also about how do you plan your finances? And that's not, to my mind, a sustainable thing to be doing. So governments are consolidating. It's taking a bit longer than we thought, but it's happening. Corporations. What have corporations done? Corporations in the UK, corporations in the United States are sitting on a large pile of cash. Now, there's a big change from 2006-07 when they were all sitting on fairly large amounts of debt. And so they've changed their model around it. And I think it's been a very, very healthy thing to have done. And British corporations in general used the fact that sterling fell in the aftermath of 2007-08 because, of course, a lot of people interpreted quite correctly that the UK economy was very, very dependent upon financial services. And sterling fell because financial services obviously took a real caning during that time. Exporters sat there and thought, well, rather than gain market share, what we're going to do is raise our margins. Now, you can sit there and say, typical short-term British business, why did they gain market share when they could have? Except that what they used that extra margin for was to pay back debt at a very, very rapid rate. So actually what they did was pretty responsible. Now that sterling started to appreciate, up from 150 to about 170 now against the dollar, they've got actual room to continue to maintain market share because they've got space in the margins and they don't have the debt load that they had before. So I think actually what corporations have done is pretty good. Banks. What have banks done? Well, banks, without question, got very, very into the party of low interest rates and ample liquidity. They clearly lent too much. They clearly didn't have anything like the controls they should have on who was borrowing. Now, there are two people in any equation. There's the person who's borrowing too much and the bank who's lending too much. The bank should have been saying no, and people shouldn't have been applying. But so the blame could be liberally ladled about. But the fact is, banks lent too much. And there's a thing in banking called Tier 1 capital. Tier 1 capital is your super safe stuff, and you've got to maintain a certain portion of your loan book in Tier 1 capital so that if things go wrong, you've got a buffer. And the Tier 1 capital ratio used to be 2%. It's gone to 12. So that, leave aside all the other regulatory changes, that is the single most sensible thing the governments have done. It's not just the UK government, but it's US. Canadians always had it very, very high. European governments, all these governments, it's under the Basel regulations of international banking, they've raised the amount of capital the banks have to hold back. So when you see a minister in the last few years saying, I want banks to lend more, that minister was not stupid, but what they were saying was stupid. The reason it was stupid is because, of course, if you tell a bank that you've got to raise your Tier 1 capital from 2% to 12%, of course, what they're going to do is retain lots of profit, be very careful about what they're lending because they can't lend because they've got to raise all this new Tier 1 capital. So the minister is basically telling them to do something which the law is telling them that they can't do. So banks have come a long way and finally come onto households. Now, the reason I've left households as last is because it's the most important. About 2/3 of UK GDP is all of our spending, household spending. What what did UK households do? As a whole, we're way too addicted to debt, even more addicted than the Americans. And the Americans love debt. So Britain topped out at about 190%. So the average person in this country had 190% of their income in debt. Now, for all of you sitting around this room, I'm sure you're all extraordinarily responsible, and you're sitting there thinking, 190%, this is, by the way, before mortgages. This is not including a mortgage. So you're thinking, oh my gosh, I have nothing like that. Okay, that's great. But other people obviously are having much more irresponsible lending because that is, or what was, the average rate of debt. That's come down. It's come down from about 190% to about 140% very quickly. And if you look at some of the most egregious form of lending, which is mortgage equity withdrawal, which is people borrowing money on the capital in their homes and spending it on things like widescreen TVs, nice holidays, new cars, whatever, which again, in 2006, seemed for some people a good idea and certainly felt great at the time, but wasn't particularly sustainable. That money has come down really, really quickly. Now, it's about I've got the figures actually in that sheaf of papers. It's about 280 billion that was taken out of mortgage equity withdrawal throughout the boom period. And on my initial calculations, looking at how quickly it's being paid back, it was going to take us until about 2017 to pay back. In fact, it's been much, much faster than that. The British population as a whole is now, this summer, going to reach a stage of equilibrium. So people have paid back a lot of the most egregious forms. They're paying back a lot of the other debt. And that's good, because if we're looking forward from here as to can the economy sustain, a longer term economic, nice, slow, 2% GDP growth on off into the future, which we'd all like, you're not going to be able to do that if you've got a lot of debt already in the economy. So I think things are being repaired. There's a little bit further to go because I think there is a bit of a need to pay down a bit more consumer debt, but we're making rapid progress. So I'm, on that side of things, really quite optimistic. What else makes me optimistic? If you had said to me in 2006, 2007, that we were going to have a recession of the depth that we experienced, I would have said to you, well, welcome to 15% unemployment, because it's going to be terrible. That sort of recession, historically, would have led to substantial unemployment. Now, I'm not saying unemployment didn't become a problem at any time, but it never touched anything like it. It never came through 10%. I think it peaked out at about 9.1. So many millions of people, certainly tens of thousands of people in this country, kept their jobs throughout this recession, which is a great thing. It keeps people skilled, it keeps people motivated, it keeps people paying their bills, buying their groceries, it keeps families together, all sorts of fabulous positive socioeconomic things that happen as a result of that. Why did that happen? I think there's two people that can take some credit for that, employers and employees. So really a lot of people. Employers, because they didn't just take the slash and cut approach to it all. A lot of employers, I think, have grown up to realize that employees are difficult to find good people quickly. And so if you slash this year, don't think you're just going to be hiring people next year, because it isn't going to happen like that. And employees took the responsible attitude of, if my employer doesn't have the money, there's no point in my holding up saying, you must pay me this. If somebody's offering me 30 hours a week, I might like to work 40, but I'd rather work 30 than none. So how about a bit of give and take? And there was a bit of give and take on all sides. And I think that the result was a much, much better employment situation that happened in the UK as a whole. So what do we have to do now to really set our economic course on a good position? Well, the key one is going to be productivity increasing. Productivity is something that a lot of economists, a lot of politicians bang on about, and it can become a little bit dull. It actually does matter an enormous amount. And if your productivity isn't good, it's pretty difficult to see you raising your long-term rate of growth. So what are some of the good and bad things about that? Well, I suppose in academia, if you say to somebody they have substantial room to improve, what you're really saying is they're not very good right now, but you're putting it in a nice way. The UK productivity has substantial room to improve, which I think you'll all accurately see as meaning we're in the middle of the pack. We're down there with Canada and Italy, which is fine, but not as good as it could be. The top performers in productivity tend to be, for various reasons, Germany tends to do very, very well. If you wanted questions and answers to why I don't think that's sustainable, I'll talk about it. The US does very well. A number of other countries do very well as well. So lots of room to improve on that, which is extremely valuable, because One of the other things that we're here and looking into the longer term, and I'll now just spend a next couple of minutes before I turn over to Graeme looking forward. What are the two things that looking forward that are going to be affecting us as far as the UK's long-term prosperity? One is our demographics, and one is technological process. So let's start with the bad one first, demographics. We're at a bit of an inflection point here in the UK. We're not unique in that. The US is the same one. Much of continental Europe is the same one. But if we think of GDP very simplistically, it is productivity, which remember has room for improvement, plus the number of people working, your working age population. Add the two together, and you've got pretty much your GDP growth. The change needs those GDP growth. Unfortunately for Europe and the United States, working age population is now going to be set to decline for the next 20 years, maybe even slightly longer. So what does that mean? Well, if you looked just over the last, I think I did the data since 1960. 1960 to now, the productivity plus population increase or working age population increase gives you about 2.5% growth per year over the long term. So that's pretty much our trend rate of growth, 2.5%. If you just assume that productivity in future is going to be the same as productivity in past, we can argue about it, but not a totally insane assumption, and then lay over the demographic change, our trend rate of growth drops to 0.8. 0.8 is going to feel like a recession. 0.8 isn't a recession officially, but it's not going to feel good at all. So what do we need to do to counter that? Because right now, that's sort of where we're headed. One is to raise productivity quite clearly. And the way that we're going to raise productivity is through a lot of technological change and a lot of getting people to be more agile, getting people to be more flexible. And I'll just touch on a couple of things that are happening in that. If we look, there's a great thing which is called the Global Entrepreneurship Monitor, which is run by a whole panoply of universities around the world. It's Aston here in the UK, it's Babson in the US. But what they look at is how many people are entrepreneurial, how many people are starting small companies, how many people are employed, what percentage of your GDP, et cetera, comes from all of this. And it's very, very interesting. And two things you can see on that, and I'll close on these. One is that Europe as a whole used to be in the middle of the pack globally in all of this. And what has happened over the last 20 years is Europe has faded back. You can watch year upon year, just fades back each time. More and more countries are leaping ahead of us. Why are they leaping ahead of us? Because we're going through technological change, which we haven't proved very, very good at addressing with the same rigor that other countries have. Against that, the UK does pretty well. We tend to be at the top of the league. The problem is that's the league that's falling back. So we're better than Germany, Italy, etc. The only non-European country in the bottom quartile now is Japan, which, as all of us know, has been about a 25-year recession or near recession. So the UK does better than most of the Europeans. Netherlands also does pretty well, but needs to do a lot better if it's going to start to repair that gap, which is going to sit as a big challenge in the next few years. And with that, I'll turn over to Graeme. Thanks very much.
Thank you, James. Good afternoon, everybody. It's lovely to be back here again. I haven't shelled the Highlands and Islands, so I expect a warm response. But I'm going to follow in much the same vein as James. I'm going to look at the short run outlook and then move into the long run. But I think I'll spend less time on the short run. I was quite skeptical about UK economic outlook for many years, and then about 18 months ago I became more confident, and much of that was around a turnaround in the growth in the money supply, which was not dramatic, but it was sufficient to move the growth upwards from what was pretty anemic to non-existent to something which was approaching trend growth. But one of the things I argued as well was, unlike traditional economic recoveries, we weren't going to get a strong period of what we call above trend growth, when because of the spare capacity in the economy and the lack of an inflationary threat, the economy can be run at a faster pace. I didn't see the strength there to do that. And growth picked up last year, and it's looked pretty good for this year, maybe around 3%. Forecasts are in the sort of central consensus right now in the sort of 2.5% to 3% for next year as well. Not quite so confident as we get into next year. Still got some concerns about the financial system. Still got some big concerns about the euro crisis. That we're not at the end of it at all. We may just be the end of the beginning, actually. But timing there is very difficult to predict. But there are still fundamental issues attached to the Eurozone which have to be addressed and will be addressed at some point. One just doesn't know when. So it looks warm and sunny for some time to come. But bear in mind, this is not a period of strong above-trend growth. You know, look at the recoveries in the second half of the 1980s. You know, you're getting 3.5%, 4% growth out of that. We're not talking about a scenario up there. And yes, there could be some flow, and you look at some sort of flurry of growth this year, and confidence measures are strong, and the labour market looks stronger. But there are still some issues there as well, because as James pointed out, household consumption is such a big factor in overall growth and prosperity. But at the same time, the savings ratio isn't up in double digits, so we can get all confident and draw down on that money. It's not like that. It's half that rate. And so the capacity for drawing down on the savings ratio to fuel consumption growth is much less than in previous recoveries. I'm not saying it can't fall further, it can fall further, but it would be approaching the levels previously associated with what you might call an economic boom, not an economic recovery. So there is constraints there. I think business investment will come back, the confidence measures are there. Larger firms in particular have the cash in the bank to do this. So again, there's some optimism from the business side. So you've got consumption, you've got the business sector. Clearly, the government sector is really not paying much of a contribution there because of continued austerity. But you know, there were some pretty big punches there from the household sector and the business sector to keep growth moving forward, certainly over the next 12 or 18 months, I'd have thought, for us not to be too alarmed. So you're looking at sort of 3%-ish growth scenario, which is going to feel nice, certainly feel nicer than in recent years. But there are constraints. I don't see a huge surge from net exports, although the UK is now exporting more to the faster growth economies than it was only before the financial crisis. So that will help because these areas of the globe are clearly faster growing. Therefore, you know, you get more bang for your buck in terms of exports. So some good stories there, but not a major contribution. The consumption story, the household consumption one is the key factor there. And I mentioned the savings ratio. Yes, labour market is doing well, but there are issues there. You know, there's a lot of the growth in employment has been part-time as well. But I think one of the key factors, James pointed out, in the recession, there was a lot more give and take, as it were, between employer and employee at that stage. And that was very much about, you know, I'll take a pay cut and do fewer hours. But there's a flip side on the other side on recovery. If you haven't laid off during the recession, then you don't need to take on as much in the recovery, especially if that recovery isn't above trend and is a more muted recovery at the same time. So I think we've got to be a bit measured about this and responsible. But it does, you know, for the first time in a long time, it's not immediately obvious what's going to derail recovery at the present time, which is a positive. And there's also, you may say, oh, this is the old housing market. You know, you look on the news and boom in the housing market. Well, again, there will be a ripple effect, I think. It's going to take a while to get up here, guys, I think. But there will be a ripple effect out of the London and South East, if history is any guide. But it's not going to be dramatic. And thus far, if there is a bubble, it's in the prime central London market. The organisation I work for now is based in Mayfair in London, Oligarchville. And there are not many people living there, but there are an awful lot of expensive houses which are going up in value considerably. And there is a ripple effect. Help to Buy has not had a dramatic effect, although I think it could have a greater effect moving forward a little bit more. What we need in the UK economy is help to supply, not help to buy. But the housing market effect, it will help confidence. But actually, much of the time, the key driver actually is not on consumption, is not things like housing market confidence. It's what's behind the housing market confidence, is what's behind that growth in house prices. And the primary driver there is real incomes, it's household incomes. And that's been the big change, which has been unfortunate for the leader of the opposition, who kind of banked everything on inflation staying ahead of earnings growth. And now we're getting a combination where that's not happening. Inflation's fallen back, earnings growth has moved ahead slightly. And I think one of the other factors associated with stronger economic growth will be an improvement in productivity performance, and that will permit firms to pay slightly higher wages as well. So that will reinforce the real income growth, which is beginning to occur. And so consequently, again, that's another positive factor. Helps the government, helps the Chancellor, doesn't help the opposition necessarily. Counter-argument to that, of course, is that John Major had an even better economic position in 1997, and he got thumped as well. So voteless economic recoveries are not impossible. And so the classic story about this is kind of shoes in the government for the future is very uncertain. But I think it's probably safe to say you've got even more uncertainty up here, so I'll stay off that one. So in the short term, looks okay. Uncertainties again at some point on the euro crisis. What I wanted to do as well, though, is kind of wrap up with just taking a look a bit further forward onto long-term growth and long-term potential here. I think on the positive note, there are so many factors out there where the world is changing. The shift in output from east to west, it's not from west to east, it's not a zero-sum game. It doesn't mean they gain and we lose. Economists don't agree on much, but one thing they do agree on is the benefits of trade. And it will make a bigger pie, and we will all ultimately be better off as well. So in the longer term, the potential for the global economy and the potential, if the UK remains competitive, is enormous. We've got to remain competitive, though. I'm slightly more pessimistic than James about the extent of our competitiveness. I worry about the size of the state and how it's undermining the trend rate of growth. I actually think the trend rate of growth could now be down towards 2%, and I think it's falling. I think we have to address it, but that's a contentious area. But I think it's one of the key areas of the 21st century, the size of the state and the scale of public debt. I do not think the advanced economies are going to be able to run the size of state and the scale of debt that they've run in the late 20th century and early 21st century over the coming decades. They're going to face a challenge which is going to be a mighty political challenge to deal with as well. Because what happens if they don't? Well, the situation will get worse. And that's the problem, particularly on the European continent, which is that you've got an even more severe demographic threat in many economies, not all of them, but in many of them. That weakens long-term growth. That means that the labour market is weaker. That means unemployment's higher, especially on the continent when it's already very high. That makes it politically difficult to do reform measures, which in the short term may result in even more unemployment. And so it means you back off reforms, but you've got an ageing population which is costing even more to fund at the same time. The whole thing is a downward spiral. What it needs is radical reform, so you can get your growth rate up, so you can still afford the level of public service commitment you've had before, or you don't have to cut it as much as you potentially will have to do. So there's some real long-term pressures there in terms of the outlook. If you look as well wider, if you look at China, James alluded to that sort of the deal which is there on the table at the moment, whereby the Chinese pay for the excess consumption of the West. Well, that is a problem. And I think it's going to be hit as well by an added issue, which is that the rise of in affluence, which is clearly positive, the rise of a middle class in countries like China and India. That's hugely positive in one sense for us because of what it means for the size of the global economy. But it also has other issues attached to it as well, which is quite simply that with a one-child policy and no welfare state, you save an awful lot of money in China at the moment for a rainy day. But as affluence rises, the Chinese won't need and won't want to save as much money. And therein lies an opportunity because their savings rates are going to fall at some stage. Also, as populations age as well, then savings rates ultimately will fall, although the aging process means that that's a late 2020s, not a kind of earlier mid-2020s issue. But there are big demographic issues here. There are big attitudes towards savings and consumption, which are going to put pressure on the West. Now, if you're Burberry or you're Jaguar and you want to sell into those markets, the fall in the savings rates and the rise in the consumption share is great news. somebody told me that Jaguar are planning on the basis of 30% compound growth for the next decade in China, which is that macroeconomics? Is that economic growth? Is all about economics, or is it just about a Jaguar F-type? I don't know. But whatever it is, it's going to be a powerful force. So there are some real geopolitical mega trends underway at the moment, which we're sitting right in the middle of, just in the wake of a financial crisis, which sort of has put us all in a spin as well. So a lot is happening. These things aren't going away. Robert Gates, the US Defense Secretary, was not talking about economics, he was talking about politics, but he said, crises used to come and go, now they just come and stay. And I think it's going to feel a bit like that over the coming years and decades. But there is one huge positive out there as well, and that is that we are in an era of great change. The supply side, the technological, the sectoral change, the new technologies, the new sectors which are growing at this time is unprecedented. And that will lead to growth, because ultimately that's what economic performance, it's based on innovation and creativity and technological change. Those factors are coming together very powerfully as well. So we've got some big problems, but we've got some huge opportunities there as well. And I would just say that I think one of the key things, though, is going to future economic success, and it's an issue I'm looking at myself in quite some detail at the moment, is going to be so simple and yet so profound. And that is that we look at the moment of sources of long-term economic success, and we if you think of prosperity as a river flowing from upstream to downstream, and everybody's fishing down at the bottom at the moment. They look at investment, they look at education, and these are all very important things. Fundamental human capital, physical capital for long-term economic growth and performance. But true success is actually understanding how you get that. That is a behavior at the bottom. That your performance down there results from what goes before. The behavior is shaped by institutions. Institutions are rules, regulations, incentives, the way we operate business. Those are institutional factors. They're not just buildings and organisations. It's incentives, rules, regulations. You've got to set those correctly. If you set those correctly, if you set that framework correctly, then you've got every chance. It doesn't guarantee great performance, but it provides the incentives for a behaviour conducive to economic growth and prosperity. But then the obvious question is, well, what determines those institutions? What causes that? And I would argue that it's culture, it's values, it's beliefs, it's attitudes towards entrepreneurship, and it's a spirit of vitality in the society. It's individual, it's a spirit of responsibility in society. And that applies to banks as well. So it's a spirit of freedom as well. So what we've got to do is, at the moment, we've said freedom has failed, so we've got to clamp down with regulation. In other words, if the internal locus of control has failed, we've got to impose an external one. And quite simply, that means that your growth rate will be less than if you'd relied on an internal locus of control. We've got to somehow manage that. That goes back to values, attitudes, and that's a very hard one to change. But fundamentally, that's what's going to drive prosperity in the long run. Because if you get those values right, if you get that internal locus of control, that will improve, hopefully, the institutional structure and the incentives within society. That will lead to the right sort of behaviour, and that ultimately will lead to greater economic performance and prosperity. And what are those values? They're pretty simple, some of them. Honesty, trust. Lowest transaction cost leads to more economic activity. How much economic activity never occurs? Quite simply because you don't trust, you're not sure, there's uncertainty, can you rely? And it doesn't happen. So you never see that. That's never recorded, but that's a reality. Freedom, absolutely fundamental, but with responsibility as well. Vitality. I just finished with this one. Edmund Phelps, the Nobel laureate, recently wrote a book called Mass Flourishing. And he looks at the takeoff in economic performance in the 19th century, and he looks at all the kind of standard economic explanations of it, and they don't quite fit. But what does fit, and what does provide a compelling story and explanation, is that he looks at the issue of vitality, and he says the attitude of vitality you had then, the frontier spirit, the entrepreneurial spirit, led to innovation. We think of innovation now and the latest iPad. Actually, I hope they are bringing out a new iPad. I haven't done anything new recently. But you look at big firms and innovation, and we think we're in an innovation-packed world. And to a degree we are. But actually, we still don't have anywhere near the scale of innovation we had in the 19th century. And one of the things there we need is that spirit of vitality. Just to flip into the economics of happiness and subjective well-being, which is a new kind of strand coming up over recent decades. The values we like at work, what we want to do to make a difference, to be seen to be making a difference, to try and change the world, those sort of values, as opposed to I just want to turn up and get a paycheck. The values that make us happiest at work are also the values which in aggregate for society maximise innovation. And I think if we can get there, if we can maximise that spirit of vitality, then success is guaranteed. Thank you very much indeed.
Can everybody hear me? Mm-hmm. Probably hear me about this anyway. Okay. That was fascinating. I was sitting there thinking, one of the things that struck me was that from a couple of economists, we had some history lessons, we had some philosophy, and we've had somebody talking about trust and honesty and values as well, which is great to hear. We've got about 15-20 minutes for questions. I'm going to throw it open to the floor. Has anybody got a question that will really challenge these guys?
If so, James will take it.
Who's going to go first?
I don't know how much it challenges it, but you're making the point about GDP falling, or GDP per head perhaps falling as people get older. Now there's a trend of people working...
not falling, but growing at a very slow rate.
Yeah, growing at a slow rate. More and more people are working late in life after retirement, and some people are talking about that going up to 50% of the people who've retired. So there's obviously an opportunity there, especially if productivity is high and people are coming into jobs where their productivity is high. But I think an interesting question is how that could be linked with needing more enterprise, because where people are retiring from perhaps well-paid jobs, public sector jobs, higher jobs in business, these are the people, in a way, that you want to be starting new businesses if they're going to carry on past 60, 65, and questions of incentives and how that can be encouraged is, I think, an interesting question.
Okay, you've got the panel.
Okay. Yeah, if you look at 1980 at the average productivity of people over their lifetime, instead of looking at it on a snapshot by snapshot, you look at longitudinal, which says how do you over your lifetime, how does your productivity go? It obviously sort of starts, say, a 20-year-old, they may be finishing education, etc. By the time they're 25, they finish, and then it's slowly rising, and it peaked at about 45, and then started to fall off, and by the time it hit 60, it was falling quite substantially. And I think that the type of economy that you had in those days was the sort of economy that was typically the case. It wasn't as service-oriented, it wasn't as intellectually dependent economy. Today, what we see is a much slower rise up of productivity, and also it tends to steady off. Yes, it falls slightly, but really very little falling away, which is great because, as you say, people can be very much do interesting jobs for longer than they like, be useful members of society, keep on into their 60s and even to the late 60s. Quite easily, and I think that's going to be absolutely. I did look at the numbers on, could we just say that a large portion of the problem on UK trend rate of GDP growth, could that be addressed by pushing the retirement age back by a number of years? It certainly helps the government finances in terms of our pensions affordable to do that, but it doesn't really have that big an effect on the GDP numbers, largely because they're not that big a portion of the total workforce, and it pushes back a couple of years. The problem's still the problem, in so much as I'm sure we would agree that people should be looking towards moving toward retiring towards the late 60s, but they're still looking towards retiring. They're not moving back from 64 to
Does
60.
that map across then the technology companies as well, when you say the productivity? Because technology companies tend to be started and led by people that are very young.
We've not seen that because typically the skills that older people have have not ended up being in technology companies. So I think that it's not been an area where you've seen a lot of older people, just because they didn't have that skills when they were in the 1970s when they were starting their careers, and they've not developed them to be developers of that since then.
I agree with James. It kind of pushes things back a bit, but there's no strong solution there immediately obvious. But I think one of the key pressures that is going to happen, though, and it's just purely stemming from the inside of the individual. If they've got, maybe not in the public sector, but in the private sector, if they've got insufficient pension provision, then people are going to have to be finding work. There's a bit of a delusion at the moment, and we're not seeing it. It's a sort of calm before the storm. Because if you look at sort of replacement rates for retirement for people, let's say my parents' generation, who retired, sort of late 90s through to the noughties, their replacement rate, in other words, their pension income as a proportion of previous income, was at the highest level in history. So, and we were then looking at our parents and thinking, well, maybe we should worry about this pension thing. Well, half of them want DB schemes, which are not going to be there, and even so, a lot of it, when they weren't, they were on DC schemes, which had ridden, the equity boom of the last 30, 40 years. Again, something which we can't guarantee in the future. Although I would say, I think I've got more optimism in the future. I think the sectoral issues I mentioned about new technology, new sectors, I think that will actually be hugely beneficial to us. But from a pension perspective, that's a long-term thing, which is not necessarily going to be apparent in the next 15 or 20 years. And what am I saying then as a result? I think a lot of people are going to hit a shock. I think there's going to be a significant savings catch-up in this sort of 2020, 2025 plus period, where people reach 55, look at the pension provision and just think, I'm going to be on 8,000 quid a year. And I've currently got a salary 4 times that, or 5 times that, or 6 times that. How on earth is it going to work? And at the moment, they're not doing that. One of the compensations might be that the buy-to-let boom over recent decades may be the pension provision that we're not capturing in the statistics. But it probably needs to be, because otherwise a huge number of people are going to have to find a part-time job. But as James says, you probably can do, because it's not necessarily manual labour now in the future. It's intellectual capital. You can just sit at home and do something on the computer still. So I'm not saying it's impossible, but there are some immense challenges out there, and a lot of people with very myopic behaviour who are going to get an awful big shock. Thankfully, they're not going to just find out the week before they retire, but it does mean, if you're intensifying your pension saving when you're 55 as opposed to when you're 25, you've got a big problem.
Okay. Question at the back.
Yeah, I was going to ask you about the role of immigration in your long-term thinking, because you're in the part of Scotland today that is the second fastest part of Scotland in terms of population growth between the last 2 census. Inverness grew by 18% population, and it just strikes me that a lot of the political noise down south is less immigration, but in terms of the demographic challenge, surely you need more young people coming to the area. The world population is growing from 7 billion now to 9 billion in the future, so there are going to be more young people potentially coming from other parts of the world looking to come to places like this. I just wondered what your take on immigration and the current politics of immigration, particularly south of the border, is.
Well, on the economic front, clearly, as James pointed out, it's basic. Labour supply does contribute to growth. And certainly the London economy would not be as strong or as grown as much as it has in recent years without the immigration flow that we've seen there. There's absolutely no doubt about that as well. But we know and UK population is predicted to go to 80 million by, and a huge swathe of that's going to be in the southeast. And given our planning system and the implications for the housing market, a lot of people are going to struggle to live there and want to move out to cheaper areas. So I think there are 2 issues. One is within the UK migration, so it's going to stimulate a lot more activity there, which is probably good for you guys. But at the same time, the there's a complication as well between obviously open labour markets within the EU, which will obviously continue to facilitate growth because it will suck in labour supply. Closure of basically labour markets outside the EU, and the whole political and cultural dimension which mixes in with that. What does that mean? If the economy stays strong, the political pressures to not have to deal with it are probably strong as well. They can get away with it more. But if the economy is weak and unemployment is rising in certain areas as well, then the whole cultural issue comes back in as well and becomes a huge political problem. So a lot depends on the economic backdrop against which you're talking.
Okay. Other questions? Gary?
Just wonder, I was very taken with the comments that you're making about needing to look at values and trying to capitalise on those. Just now there's probably less trust and less confidence, particularly in business and particularly in the financial sector, than we've had for generations. And we're also seeing a perception, and I think it's real, that we're seeing a much more unfair and divided society. Now, if we go for values which promote entrepreneurialism, which would create growth and incentivise that, then that unfairness could extend. And we've seen, I think, a growing unfairness between those people occupying the better paid jobs and those the worst. The problems with zero-hour contracts, with temporary contracts, seems to be growing. I'm just wondering if in your modelling, if we're wanting to move to an area where we can have values that promote growth in a way that people see well-being increasing, what are the things that we need to do?
James.
Well, there's two very distinct things in there. One is about the whole flexible labour market, zero hours contracts, etc. The IOD has been very much in favour of all of that. Very few of our members use zero hours contracts. It's more philosophical backing for it. And as I said, one of the great things about this recession has been that unemployment has not become as problematic as anybody would have expected, and that is directly attributable to that. So if we want to look at where a lot more employment protection leads, it's very easy. Look at continental Europe. They have got criminal levels of unemployment in some of those countries, approaching over 50% youth unemployment. Spain, Greece, is that. That will be a chronic problem. Those countries are absolutely panicking about what to do. And they should be, because it's absolutely appalling. On the income effect, this is something I've looked at, in fact, and just written a big paper called periodically, but a big picture is all of that. I am somebody who is firmly in favour of greater income dispersion. I think it's been very good. It's made a much more dynamic, entrepreneurial society. If we look at what has happened in the UK, looking at the last 30, 40 years, I'm very familiar with the data. Look at something, a simplistic measure, which is the Gini coefficient. I think it tells us something, not the whole picture by any means. Our Gini coefficient, which is a measure of inequality in the economy. So 0 means that there's absolutely equal distribution of income. 1 means 1% all income. Clearly don't want to be 0. Clearly don't want to be 1. It was about 2.24 in the UK, at an all-time low in the late 1970s. And went up quite radically over the course of the 1980s, as you probably would intuitively suspect, to about 0.36. It's now reached about 0.40, which is right around about the global average. Europe as a whole tends to be quite low, but lots of other developed countries tend to be a bit higher. So that's why we're sitting at the average on all of that. What are we proposing to do, and people proposing to raise substantial amounts of tax, etc., to trying to rectify this because they want a more egalitarian society? There's about 4 things that we look at the late 1970s and now as to why it's different. Late 1970s, we had a very different economic structure, tended to be much more heavy industry, tended to be each individual was probably using a capital-intensive machine, and their value was, the value of the process was much more in the machine than in the individual. as that shifted, because the value is now much more the individual, so too is that individual's ability to negotiate income for themselves out of that has changed. We've also seen a real diminution of trade unions, who tend to be, again, if you are relatively uniform in what your job is doing, a union can be a very good thing for you to represent yourself. If your individual capital is more what determines your value, you're probably better negotiating with that yourself. The final thing that's changed immensely is that in the late 1970s, we clearly had a punitive tax rate, 83% for the higher income. 83% taxes means that nobody pays it, because nobody will work for it. So the only people that get caught out are lottery winners and rock stars. Nobody else gets the money, because they just, you don't get an entrepreneur, because why? And we have to look at that and say, do we want to now introduce that? Because of course what we would be doing would be taking money out of high taxes, whether in the form of mansion tax or various other taxes. We'll be taking money out of the investor part of the economy and taking it into direct spending. At a time when we're undergoing a big technological revolution, I would say that's probably one of the stupidest things you can do, is to take all of our long-term investment capital and push it through in order to not have to face hard decisions about what do we want out of a welfare state, what do we think the state should pay for, what do we think should be, it can become more efficient in the long term. So, Fred, I don't agree with you at all, but I'm more than happy to discuss it.
Yeah, I think I'll answer it in two ways, using the recent Thomas Piketty book, Capital, and then just talk about kind of the moral case for capitalism as well, because I think that's, so I'll get back to the values, but on the income distribution figures, James was talking about the UK ones. Piketty says that lowest income households in the US, basically in recent decades, their income has gone up 3%, so it hasn't gone up, it's just been flat, and then, I can't remember the number he says for the highest income households. But then, when you look at the numbers, and then you say, well, hang on a minute, now, in fairness to him, he had to use this data set to have comparative coverage. But the data set he used meant that he was using, there were household measures and there were tax unit measures. And for tax unit, a man and wife counts as one unit, but two people cohabiting count as 2 units. And that's quote the figures. So if you allow for that, if you also say, and he doesn't include it, that low-income households obviously receive transfer payments from the government, they get benefits and things like that. So it seems reasonable to say that's part of their income as well. So you factor that in. And you make a couple of other methodological adjustments. That 3% effectively nothing increase over recent decades goes up to 37% over recent decades. So some of the data sets on income distribution are jolly misleading at first sight. And you have to take that into account. It's not just on the income side as well, because on the wealth side, he says you've got all the wealth of the house, the top households. But actually, he then ignores the fact that in the US, is a US context, obviously, that you have got access to in the future. You may not have a pension pot, you may not have any pot at all, but you've still got some future wealth. You've got the future Medicare payments to you, or Medicaid, and again, when you factor in that, the actual wealth has to be considered, because the unfunded liabilities there in the US alone are $11 trillion over the period we're probably talking about in the context of this book. So again, distribution of income, distribution of wealth, it's not a simple matter of the headline statistics. There's a much deeper story there. You talked about trust and values and what I said, and I profoundly believe that they're important, but I believe they're linked to the moral case for capitalism as well. And people laugh at that because they see Gordon Gekko in Wall Street shouting greed and good is good, and it's a zero-sum game, and he wins or I lose, or I win, he loses. It's hardly an uplifting moral tale. But it's a complete straw man, because the whole essence of capitalism is competition and service. It's not about greed. The whole system, it does not require greed at all. Capitalism functions without greed. Now, you can let greed in if you want to, but it's nothing to do with the system, it's to do with you and I. It's us making a personal choice to do that. Now, you could say they're following incentives, but it's all about freedom. Capitalism works when you maximise competition, when you've got the competitive forces there, when you've got free entry and exit, when you're into the market, when you don't have monopoly power, when consumers are being served, you're responding voluntarily, it's a voluntary exchange between you and your clients. That's when capitalism works. Now, clearly there are what we would call excesses, but it's quite strange. People get upset about a bank CEO earning $20 million a year, and I understand why they do, because they say where's the link to performance. But people don't scream in the back of newspapers about Rooney's paycheck at £300,000 a week.
They should now.
Yeah, they should have. It's not linked to performance. So yeah, they should have. But that, people talk about the profit motive as if it's evil. But everybody in this room has a wage motive, and if they're selling their house, they have a house price motive as well. What's the difference? It's just in your own self-interest. Is wanting to get a higher salary because you think you're working harder, is that utterly selfish, or is there?
So you've talked about values and changing behaviours and all of that. What about then at institutional level? Big finance houses and banks. There is a lack of trust. What should the banks be doing, and what's the institutions? Because they've got to build our trust again.
Well, I think you've got a point, but this is a complicated question, but I would bring it back to the core values of capitalism, which is competition. If you look at, most of the banking problems on the investment side, we would say, from what you're saying, versus the high street. But if you look at the high street, Metro Bank's the first new high street bank in the century. Where's the competitive forces in there? When you've got investment banks, which make I don't really want to get too far into this because I think it's very nuanced, and I think there's a lot. Although banks clearly did things wrong, I also think they've faced an awful lot of unfair criticism as well. So I think it's a nuanced area. But the one way to deal with that is take away a situation where you've got investment banks which are too big to fail. Because if they're too big to fail and they know it, they will react and behave accordingly. And that's when it goes back to the institutions, and because the institutional structure is if they're going to be bailed out, they know that, and it goes back to values where they need to get back to individual responsibility. In other words, something called my word is my bond.
You're against regulation and control, but you want regulation and control to stop banks getting too big.
Well, you want a framework which ensures the maximisation of competitive forces. So there is a role for government to do something there, but there is a very big difference between ensuring healthy market competition and second-guessing every act that every banker is going to make.
So what can banks and financial institutions do to build our trust again?
I think if a relationship is broken down, it takes time, doesn't it? Just as it does with people, it will with institutions.
Okay. Other questions?
I wondered if the IOD had modelled a minimum wage nearer to what's called the living wage, offset by reductions in employers' national insurance contribution.
We have, and I'm trying now desperately, of course, to remember exactly what the conclusions were. We have very few members who pay staff minimum wage, so it's not been that big an issue for us. No, in general, our view would be we want a flexible labour market, and things to wage rate should be decided by productivity rather than fiat of the government pushing up a minimum wage in that regard. There is a very interesting graph that Draghi, who I think has actually done a very good job as head of the ECB, he put together a devastating bunch of graphs which he had at the Council of Ministers in March of 2013. And essentially, a bunch of graphs do this. And the bottom one is productivity in the Euro country, and the top one is zero wage rates. So every single one, there was a wide looming jaw. This is from the day of the introduction of the Euro. There was one country that was an exception, Germany. It had two lines like this. So Germans didn't overpay themselves as they introduced the Euro. Everybody else said, oh yes, wonderful, we will. And now we have a crisis across the Eurozone, affecting every country except, well, Germany, Netherlands, and Finland. Go figure. I don't think, if for IOD members it wouldn't be a particular issue. For the economy as a whole, I think it will be an issue. It's not going to be the end of the world. And one of the problems with a lot of these things about zero-hours contracts or this is that individually, you can make an argument for each one. And individually, they don't seem to hurt. And moreover, they don't often hurt right away. But you saw over the course of the 1980s that we undertook an enormous number of substantial changes to our labour market. And when was the first time that they benefited the UK? Really, you could argue as an economist, it was the coming out of the late 80s, early 90s recession, that was the first time we saw the benefits, because at that point, the flexibility was built in and people trusted it and they started to respond to it. But if I said, you're working for me, and I say, well, I'll whack another £5 an hour onto your salary, thinking, oh, this is wonderful. Well, I'm probably not going to sack you straight away because you're a good guy and you're doing good work. But come the recession, I'm going to go, gosh, at some point, I'm going to let you go. And I'm going to be more reluctant to hire you because the entry rate fee that you're charging me your wages is that much higher. And that's the sort of thing, and it doesn't matter whether it's a disincentive to let people go or a disincentive to hire them to begin with from high wages. That type of thing happens all the time. So it's something particularly effective that doesn't affect the IMD, but I think it will affect the economy as a whole.
I mean, I was the idea when the minimum wage came in, and there were lots and lots of papers floating around saying that hundreds of thousands of jobs. I remember Ian Lang, ex-Secretary of State of Scotland, who was DTI Secretary in the mid-90s, saying that 800,000 jobs were lost. I was always slightly sceptical of the scale of the impact, and I didn't think it was going to have that impact. It was partly borne out from some member surveys, as James said. It's very clear that only a few. Now, clearly, though, there was a sector skew there, so if they were in hospitality in certain sectors, then they were more affected. So it was more of an issue. For virtually the overwhelming majority of members, it was a non-issue. But for a sector, it was. And we kind of said, of course, the obvious thing, that it depends what the level is. A 10 pence minimum wage isn't going to change anything. £1,000 an hour minimum wage might have an impact. And so it did depend on the level. The initial level came in. It was broadly okay. But we then said there's always a slippery slope, or the escalator here, that you over-index. And we're going to get over-indexation of it this year as well. And my fear with the over-indexation is that over the years now, we've taken it to a position where it actually will significantly impact certain sectors. We're not picking it up, though. You're not picking it up in the data at all. And why is that? It's quite simply because this is pushing activity into the shadow economy, and especially in terms of people moving to the UK from Eastern Europe, for example. So what this is actually doing when you get heavy over-indexation above, and in other words, you're creating a gap between what people are being paid and what they're producing to that degree. And that gap hasn't, I think, for much of the early years of the minimum wage, was not a problem. I think we've begun to create a problem. I think we'll intensify it this year, but we won't pick up on it because it will just push activity into the shadow economy.
Yeah, the point I think you picked up was I suggested that perhaps there was some offset of the overall increase in labour costs by reduction of national insurance contribution from employers, and it's the fact that many minimum wage earners are also recipient of some kind of income support benefit.
Yes.
So they aren't free of the state system of support, and I'm just wondering whether it had been modeled, whether if you increased the minimum wage, you reduced contributions from employers, so you were taking people out of the whole state cycle and the whole flow of money into the state and back in terms of benefit.
Sorry, I didn't express myself very clearly because I was trying to address that issue by saying that is a very difficult calculation to make, because you have to make assumptions about people coming in and out of the official and shadow economy in response to those incentive changes. And it's not at all, because we don't know how many people are outside in the shadow. It makes it complicated. Sorry, I didn't express it very clearly.
We have time for one more question. We have one more question. This is your opportunity.
One of the ladies.
Yes, we need a gender balance.
I'll ask you a question.
Yeah.
You talked about Britain being ahead of Germany in terms of technology. So how is it that Germany are ahead of us in terms of productivity?
Okay, I'll try and you can do the intro as well.
Yeah.
Okay. Maybe may have to continue the explanation. Germany overinvests. And it overinvests because it has a very high corporate tax rate. And then it has a very high corporate tax rate, which it marries with a generous amortization schedule of. So what they can do is you buy a machine for 10 million quid. And that machine can last 10 years. So it should be that you get £1 million a year in capital allowances to set against that machine. But I'm going to say you can have that capital allowance over 2 years. So now you've got £5 million a year you can take on that machine. So at the end of year 2, you say to yourself, gosh, that machine's got another 8 years to run. Or I could buy another one and purchase essentially a new machine and £5 million worth of tax break. Oh, I'll have a new machine, please. Now, what are the advantages of this? You're going to have a really productive workforce because they're always getting great new machines. Your productivity figures are going to look fantastic. Why can't Britain do that then? Well, leave apart the sustainability side of it, you're replacing your machines too quickly. Largely, the German corporations are dependent upon bank debt. So why don't British banks do that? Well, do you want your bank loaning out this money? Because I would say you don't actually, because the returns that they're getting on that capital, they're returning the capital too quickly. The returns they get on the capital are very, very low. You look at returns on invested income in Germany, they're terrible, consistently terrible. But if everybody's used to a terrible rate of return of income, that becomes the industry standard. Now, somebody has to be paying. Something isn't working in the system under the James Sproule definition. What's going wrong? Now, we know that the average German is both richer than the average British person, and they save more. So, leaving aside housing, Germans don't tend to own housing, they tend to rent. They should be much richer. Yet, we know the average British person has much more financial wealth than the average German. Why? Because they leave all their money in boring old savings accounts, earning next to nothing, and that cheap financing is recycled to the economy, and in the way that I've said of over-investing in everything. So great productivity figures, great figures on, you need highly skilled workers, but again, highly skilled workers where you're investing in them all the time tends to make that highly skilled work quite productive. So all that works. There's a payment, there's a cost to it, and that cost is the average German just doesn't have very much wealth. It's been used up in a system which I don't think is sustainable.
Could I just add something to that as well? The ultimate aim of all economic activity is consumption. The ultimate aim is not investment. That doesn't make us better off. I know indirectly it does because it facilitates economic activity, but the ultimate aim is consumption. And the sustainable level of consumption per head. Because you could have a borrowing binge and go crazy, and the consumption could go through the roof for a few years, but that's not sustainable. So the ultimate aim of economic activity is sustainable consumption. And if you have a much higher investment share of GDP, you've got to service that depreciation. That is money which could be in consumption ultimately in the long term, providing your investment is sufficient. And so the UK, on the measures of consumption per head, comes out very, very high. And that is the ultimate aim of economic activity. So when we look at economies, China's got this massive investment share, but it's a highly inefficient. The capital output ratio is crazy, and so you can have income per head figures which are really great, but actually what we really bother about is consumption per head ultimately, and in countries like Germany and especially China, that gap is just it's an inefficient gap.
Okay, thank you. I think we'll draw it to a close there. We've heard from two gentlemen here. We've talked about government deficits in government. We've talked about large amounts of cash in corporations. We've talked about individuals, about banks. We talked a little bit about productivity. There was a lot mentioned about technology and how technology may help. We also had quite a bit about what I would call technical language from economists, which was what I'd expect. Right. But what was quite refreshing was to hear some other things coming through about trust and honesty and vitality and values. And those really are the things that will drive the system in the future. And that's why I was making the point about the trust or the lack of trust maybe in banks and financial institutions. So I think there's a lot of work to be done on all sides before I think we can start to build that. And I'm not sure we're completely out of the woods with all of this yet. History has taught us lots of valuable lessons about how things can go wrong.
but it was so refreshing to listen to, and some frightening figures as well. I mean, when I think it was James you mentioned about 190% of income is debt, household debt. You know, that's scary figures.
That's it. That's it.
Yeah.
It's fallen. It's 140. It's still too high.
That's still quite scary.
It's still.
But fundamentally, it all comes back to that we have to have trust in both politicians, governments, and business if we are actually going to have a sustainable economy going into the future. I do believe in capitalism, but I think it needs to be tempered in some ways. And I wonder sometimes, and I may be wrong here, but I wonder sometimes, what happened to the great Quaker families of many years ago that were capitalists, but they looked after their workers, etc.? Where is that gone?
There's still a lot of them out there. I actually work for an organisation called the Legatum Institute. The founder of that institute.
Maybe that's what we need more of.
And he runs 2,000 speed schools in Africa to get children back into the education system. And he's inoculating 20 million children against worms this year as well. So these people are there.
We need more of them. I think that's it. So finally, can I thank you both for, I think, what has been a really stimulating lecture and debate. I've taken away quite a few things that I think I've never thought of before. And I'd like to reflect on those, and I think other people here would like to reflect on some of those as well. And I just want to thank also Highlands and Islands Enterprise for the continued support of the Institute of Leadership series. I'll mention one final thing, which is a future event, and if you excuse me 1 second while I can't read. We have another event here on the 16th of September with a topic that could not be more different. We have a Carnegie lecture which will be presented by Emeritus Professor Eric Richards, and we'll be exploring the Highland estate factor in the age of the clearances.
Well, I think it's very linked.
Well, I suddenly realised that it is actually very linked. I
don't understand the title.
I didn't want to push it too much. There are a few places left. I think it's going to be a popular lecture, so please have a look. You can book it through Eventbrite or by contacting our events team. So once again, thank you very much for coming along. Thank you for a really stimulating debate. I must say I really enjoyed that.
Thank you.
Thank you very much.